Gold isn't T holding up because people feel scared. Gold is holding up because the market, S internal math, is getting harder to ignore, even as higher rate narratives try to sit on its head. And then S, the conflict. The rates are high, so gold should be weak. Crowd has the cleanest textbook on earth, and yet the tape keeps refusing to behave. The part most people are missing is that the headline story isn't T, the driver right now. The structure is the curve, the carry, the way dips are absorbed, and the way price reacts to stress and then snaps back. And later in this video, I am going to give you the exact roadmap for the next 1 to 2 weeks. What level matters, what confirms the thesis, what invalidates it, and where the real pressure starts if that one level breaks. Right now, gold is doing something that makes institutions uncomfortable. It's holding a high shelf. It's been living above that big psychological zone around 4,600 this week, after pushing up from the low 4,300s earlier in January and tagging fresh highs along the way. That matters because the market didn't drift here on a sleepy, low-volume glide. It got here through waves of macro noise, U.S. data, rate expectations shifting, and the constant attempt to pin gold as a fear trade that SM's supposed to roll over the second the news cycle gets bored. But that's not the part that matters. The real tell is what gold does when it's given an excuse to fall. Because here was what normally happens when a market is running on emotion. It pops on the scary headline and then it gives it all back the moment the headline fades. It can't hold strength through bad information. It reacts like a nervous animal. But gold lately has been absorbing the hits and refusing to cave. Strong U.S. data shows up, the dollar firms, rate cut hopes get pushed back, and gold wobbles, and then it stabilizes. It doesn't collapse. That's not a vibe. That's an order book with a spine. And the mainstream will call that resilience, like it's a personality trait. It's not. Resilience is a mechanism. It means that on dips, somebody with size is consistently willing to pay up to own it. It means the marginal seller is getting exhausted. It means the people who bought too late and panicked are getting replaced by people who bought for reasons that done T disappear overnight. And that's where the real pressure starts. Now let's talk about the hidden detail, because if you only watch spot price and headlines, you're basically watching the shadow on the wall, not the object. The cleaner signal is how the gold market prices time. When time becomes expensive, when carry costs bite, when financing gets tighter, when the curve does weird things, the market stops acting like a simple risk-on, risk-off toy. And right now, the math of time is the subtext. Gold is a carry market. That sounds boring until you realize it. It's the difference between a market that S being bid for narrative and a market that's being bid because someone has a problem to solve. In a normal world, gold tends to trade in contango. That means futures prices are higher than spot. Why? Because if you buy physical metal and store it, you incur costs. Financing, storage, insurance. Futures reflect the receipt for those costs. If you can borrow money at a certain rate, and the metal has a certain convenience yield, and the market is calm, the curve usually slopes upward in a pretty predictable way. So when people talk about gold should be weak because real yields are up, what they're really pointing at is this carry logic. Higher rates increase the cost of holding non-yielding assets. In theory, that should make gold less attractive. But here's the catch. Theory assumes the market is in equilibrium, and that the only variable is the interest rate. In the real world, the curve is a battlefield. The curve is where hedgers, miners, refiners, banks, and funds negotiate the price of time. And when the price of time changes in a way that's inconsistent with the narrative, it's telling you demand is not just speculative. And this is where the spread tells the truth. Vibe comes in without us needing to get conspiratorial. I'm not going to tell you I'm going to say cartoon villain sitting in a room pressing I'm going to go stay a gold down button. What I'm telling you is that incentives matter. Dealer books matter, hedging flows matter, and market structure pressures can suppress or amplify moves depending on where the pain is. But if the curve and spreads are under stress while spot refuses to break, the paper story starts losing control of the physical story. And that S, not the part that matters to casual investors, but it means everything to the people who actually move size. So what does that mean in plain English? It means gold can hold strong even when the news is against it, because the demand underneath is not just fear buying. It can be strategic allocation. It can be reserve management. It can be hedging against policy credibility. It can be a liquidity hedge when correlations get weird. And it can be an inventory hedge when the global system is quietly re-rating what safe means. But the next detail is what flips the whole setup. Look at participation. One of the sneakiest tells in any market is when the obvious metrics, volume, open interest, headline excitement, don't match the price behavior. If gold is levitating purely on hype, you tend to see frothy participation and then air pockets when that participation leaves. But when price holds while participation cools, it often suggests that the weak hands have already been shaken out. The sellers who were going to panic have already panicked. and the remaining holders aren't reacting to the same triggers. Now, I'm not saying volume or open interest tells you direction on its own. It doesn't. But it tells you about who is left in the room. If open interest falls and price rises, that can be short covering, forced buying. If open interest rises and price rises, that can be fresh longs entering, momentum. If open interest falls and price holds, that can be the market quietly deleveraging while stronger hands take the other side. And that's where the real pressure starts, because deleveraging reduces the sell first, ask questions later reflex, less leverage, fewer forced liquidations, sturdier base, but that's not the part that matters. The part that matters is layered demand. Gold isn't one market. Gold is a stack of different buyer types with different time horizons and different rules. Retail buys it as a story, macro funds buy it as a trade, institutions buy it as a hedge, central banks buy it as a regime asset, and physical markets buy it because they actually need metal. When gold holds up into economic uncertainty, the question isn't, are people scared? The question is, which layer is bidding and why is it persistent? Let's start with the layer everyone can see. ETFs. ETFs are the big visible on-off switch for Western capital. They're not the whole market, but they bring you the most transparent way to see whether the big pool of financial demand is leaning in. And when ETF inflows are strong, they can create a baseline bid that makes dips shallower. When outflows are heavy, they can create a mechanical supply that makes rallies fragile. So when you see meaningful inflows over a year, you're seeing a shift in how portfolios are being built, not just a headline reaction. But ETF flows aren't the only institutional layer. They're just the easiest one to track. The bigger, quieter layer is sovereign demand, central banks. Central banks don't chase candles. They manage regime risk. They think in decades, not weeks. They buy when the world changes in a way that makes paper promises less absolute. That's why a central bank gold accumulation matters even if we're not an end of the dollar person. You don't need to believe in collapse to understand diversification. When the world becomes more multipolar, when sanctions and financial plumbing become a weapon, when reserves need political neutrality, gold becomes the asset that doesn't require permission. And that's not a moral statement, it's a risk management statement. Now, here's where people get sloppy and go full drama. They say, central banks are buying, therefore gold must go to the moon. That's the lazy version. The smarter version is steady official sector demand can reduce the available free float over time, making the marginal price more sensitive to short-term shocks. It doesn't guarantee a straight line up. It means when you do get a catalyst, there's less slack in the system. And if this one level breaks, the math changes. So what is the catalyst right now? Economic uncertainty is not just a feeling. It's the collision between growth expectations, inflation expectations, and policy credibility. Markets can handle bad data if the policy response is predictable. They can handle high inflation if the reaction function is stable. And what they struggle with is a world where the rules feel like they being rewritten in real time. And gold is basically a credibility barometer. It's not just inflation. It's not just war. It is what happens when you can detrust the pricing of risk-free assets the same way you used to. That is why the current political and policy environment matters, even if you didn't care about politics. If markets start to question institutional independence, they start to reprice the currency risk premium. If markets start to think the line between fiscal and monetary policy is getting blurry, they start to hedge regime uncertainty. And gold tends to be the simplest hedge when trust wobbles. But that's not the part that matters, because the physical market is the referee. If you want to know whether the move is real, you look at where physical clears. Paper can levitate because it's just claims. Physical has to settle. And one of the best reality checks is regional pricing, especially Asia. China, for example, has a benchmark in Shanghai that reflects local demand and supply conditions. When Shanghai prices trade at a premium to global prices, it signals local demand is strong relative to available supply, and that creates an arbitrage pull. When it trades at a discount, it signals the opposite. And those premiums and discounts matter because arbitrage is not a theory. Arbitrage is a vacuum cleaner. Here's how the vacuum cleaner works. Imagine gold in region A is effectively cheaper than region B after adjusting for currency, taxes, and logistics. Traders and institutions will attempt to buy where it's cheaper and sell where it's more expensive. That process pulls physical metal through the system, through refiners, vaults, shipping lanes, and inventory pools, until the spread closes. But it doesn't close smoothly. It closes in bursts because logistics aren't a T instant, and because the metal has to be the right form at the right place. Gold isn't just gold. There are bar sizes, purity standards, deliverability rules. Refining capacity matters. Shipping schedules matter. And those frictions mean that when regional demand spikes, the global system can feel tighter than people assume. And that where the hidden detail really bites. The market structure can look calm while the plumbing is stressed. You can have a spot price that's only drifting higher, while the real action is in spreads, leasing rates, or physical premiums. I'm not claiming we're in some dramatic backwardation apocalypse. I'm saying the market whispers before it screams, and if you only listen to the scream, you miss the setup. Now let's talk inventory, because this is one of the most misunderstood parts of metals markets. People hear inventories are high and assume there's no scarcity. But inventories have categories. Some inventory is deliverable into futures. Some inventory is just sitting in a vault with an owner who has no intention of delivering it. On the COMEX, for instance, you'll hear about registered and eligible. Eligible metal meets certain criteria and is in an approved warehouse, but it's not necessarily available for delivery. Registered metal is available for delivery. That distinction matters because deliverability is what matters into contract delivery windows, not total ounces sitting somewhere. Again, I'm not going to throw exact numbers at you. I can T-verify down to the ounce in real time. What I'm giving you is the mechanism. When deliverable supply tightens relative to paper claims, the market becomes more sensitive. Not always in a straight line, but in bursts, especially around delivery periods. And that's why the calendar matters right now more than people realize. January is not just another month. January is when portfolios reset. It's when funds rebalance. It's when New Year risk budgets get deployed. It's when liquidity can be weird because big players have just changed their positioning mandates. And then you layer in specific triggers like options expiry, contract rolls, and a Federal Reserve meeting right as liquidity starts to thin in certain sessions. The calendar is the catalyst because it forces decision makers to choose. Roll, close, hedge, rebalance, or press. And that's where the real pressure starts. Here's a simple way to think about it. A lot of institutional positioning is tied to rules. If price is above a certain level at month end, a system may increase exposure. If volatility rises into expiry, dealers adjust hedges. If the forward curve changes, carry trades unwind. None of that requires a headline. It just requires price to be in the wrong place at the wrong time for someone S book. And right now, gold being above that 4,600 neighborhood is exactly the kind of wrong place that forces the paper side to respect the physical side. Because if this one level breaks, the math changes. So let's talk levels, because even if you're a macro person, levels matter as behavioral markers. The 4,600 zone is not magic. It actually has a psychological shelf and a technical reference point because it boo-s, where the market has recently demonstrated acceptance. When price holds above a big, round, widely watched number, dips tend to get bought faster. Not because of superstition, but because it becomes the line between this is a breakout that S working and this was a head fake. Traders anchor to it. Risk managers anchor to it. Dealers hedge around it. And that shapes liquidity. If gold stays above that zone and keeps making higher lows, that's a sign of acceptance. It's not a guarantee of an immediate launch, but it's a signal that the market is building a base at a higher elevation. If gold loses that zone and starts living below it, the tone changes. Not because the story changes overnight, but because the marginal buyer might stop chasing and wait. And that's your first key. Not the story, the behavior. Now we need to frame this with credibility, so here's your two scenario lens. Scenario one is the controlled pullback and retest. Gold pulls back, maybe toward prior support zones around the mid-44s or the low 45s. It shakes people out, it retests, and then it either holds and reloads or it fails. In this scenario, volatility is the weapon. The market tries to convince you the move is over. Then, if the structure is real, it stabilizes and grinds back up. This is the scenario that breaks impatient traders because it feels like nothing is happening until it is. Scenario two is continuation squeeze and gap risk. Gold doesn't give you the polite pullback. It keeps pressing, liquidity thins, and you get sharp up moves that feel like they come from nowhere. That's usually when some combination of short covering, dealer hedging, and momentum flows stack on top of each other. And it's exactly the scenario that makes people chase at the worst possible spot. Because if this one level breaks, the math changes. Let me explain that squeeze mechanism in a way that isn't mystical. When price rises, short sellers lose money. If they're leveraged, their margin requirements increase. At a certain point, they have to either add capital or close the position. Closing a short is buying. If multiple shorts are forced to buy in the same window, especially when liquidity is thin, you can get a cascade. That's short covering. Now add options. Dealers who sold calls may need to hedge by buying futures or spot as price rises, depending on how their delta exposure changes. If the market has positive gamma or negative gamma at certain strikes, the hedging flows can either dampen moves or amplify them. You don't need to memorize Greek letters to understand the point. Options positioning can mechanically force buying into strength or selling into weakness. And the market loves to do this right around calendar events, expiries, month-end, policy meetings. Because those are the moments when positioning is concentrated and liquidity is fragmented. The next detail is what flips the whole setup. If gold holds above that key shelf into a calendar trigger, the chances of forced flows increase, not guaranteed, but the probability shifts. Now, because we're not doing hype for hype's sake, we have to talk about what could break the thesis. The fastest way to get wrecked in gold is to believe it can't fall. It absolutely can. Even if the long-term story is intact, gold can whip around violently. A strong dollar rally can pressure gold. A repricing of real yields can pressure gold. A sudden return to risk on with higher equity momentum and lower volatility can reduce the urgency of hedging. And if geopolitical risk premiums compress, one layer of demand can cool. That doesn't mean the big picture is dead. It means you can get ugly drawdowns even in a bull regime. Also, gold has a habit of doing the most psychologically cruel thing possible. It rallies, it convinces you it's safe, then it flushes hard to punish late buyers, and then it continues anyway. That's why your process matters more than your prediction. Because volatility can be used against you even when you're right on direction. And that's not the part that matters if you're only chasing dopamine, but it matters if you're trying to survive long enough to actually benefit from the move. So here's your viewer psychology shield. First, separate trend signal from noise. Trend signal is higher highs, higher lows, acceptance above key levels, dips that get bought faster, and structure that holds through negative catalysts. Noise is intraday spikes, headline whiplash, random data prints that reverse in an hour, and social media hysteria. Second, stop letting your emotions pick your entry. If your plan is, I'll buy when I feel confident, you'll buy when price is expensive and sell when it's cheap. The market is designed to make you do that. Third, use the two-scenario lens to keep your brain honest. If we get the controlled pullback and retest, you don't panic. You watch whether support holds and whether the rebound is orderly. If we get the continuation squeeze, you don't chase blindly. You recognize that gap risk is real and that the market can rip without giving you a clean entry. In both scenarios, you manage risk by defining what would make you wrong, not by fantasizing about targets. Now, let's get practical. Over the next 1 to 2 weeks, you're watching 3 things. 1. Behavior around that 4,600 neighborhood. Does gold keep finding buyers above it? Does it dip below and immediately reclaim? Or does it lose it and start treating it like resistance? 2. Structure signals. You're not just watching spot. Watch the vibe in futures and the curve. Is the market paying a premium for time in a normal way? Or is something in the pricing of carry starting to look stressed? 3. The calendar. We're moving through a window where positioning decisions are forced, and a Fed meeting can act as a volatility catalyst whether it changes policy or not. Because sometimes the catalyst isn't the decision, it's the repricing of expectations. Here's a concrete checklist you can use without turning this into a trading course. If gold stays above the key shelf and prints another higher low, that's confirmation of strength. If gold dips and rebounds fast on heavy sell attempts, that's confirmation of real demand. If gold loses the shelf and fails to reclaim quickly, that's a warning that the market may want a deeper reset. If the dollar surges and gold still holds, that's a very strong tell. If real yields reprice higher and gold breaks support decisively, that weakens the near-term setup. None of this is about guaranteed returns. It's about reading the behavior. And don't ignore the physical reality check. If you hear people say, this is just paper speculation, ask yourself, do physical markets show stress? Are premiums widening? Are regional prices diverging? Is the arbitrage pull getting stronger? Those are the symptoms that separate a hype pop from a structural move. Because if this one level breaks, the math changes. Now, let S tie this all back to the original title in a way that S actually useful. Gold holds strong as economic uncertainty grows, is a surface description. The deeper story is that uncertainty is not one thing. It's a stack. Growth uncertainty, inflation uncertainty, policy uncertainty, and credibility uncertainty. And gold doesn't need all of them to be screaming at once. It only needs one of them to become unhedgeable through normal assets. That's when gold becomes the default hedge again. Right now, the key is that the market is acting as if some participants are buying gold, not because they think the world ends, but because they don't love the distribution of outcomes. They don't like the tails. They see a world where volatility can come back, where correlations can flip, where policy can become less predictable, and where the price of money can change abruptly. Gold is a hedge against the tails. And when the tails matter, gold can hold strong even when the day-to-day headlines try to explain it away. So what comes next? In a normal market, after a strong run, you get a digestion phase. It can be sideways, it can be a pullback, it can be a sharp flush and rebound. The question isn't, will it pull back? The question is, does the pullback change the structure? That's your difference between a healthy reset and a failed move. And that's why I keep coming back to levels and behavior, not vibes. If you want a simple way to stay sane, do this. Pick your invalidation level first. Decide what price behavior would tell you the thesis is wrong in the near term. Not, I don't like the news. Not, someone on TV said gold is a relic. Price behavior. Then decide how you respond in each scenario. Controlled pullback and retest. You watch for stabilization and confirmation. Continuation squeeze. You avoid emotional chasing and respect gap risk. That's the difference between being an investor with a process and being a liquidity donor. And here's the subtle part, the part that separates pros from the crowd. The market will try to use your identity against you. If you're a gold bull, it will punish you for being early. If you're a gold skeptic, it will punish you for being late. It will whip both sides. The only way out is humility and structure. You don't need to be certain. You need to be prepared. If you're the kind of person who wants to understand the plumbing, who wants the mechanism, not the meme, then you already know why this matters. Because gold holding strong isn't just a price story. It's a signal about the world as risk preferences and the market as trust and policy. It's a signal about hedging demand that doesn't go away when the news cycle changes. And it's a signal that in the next 1 to 2 weeks, the calendar and liquidity can turn a grind into a snap. So keep your eyes on that 4600 shelf, keep your ears on the curve and spreads, and keep your brain on a 2-scenario track. Don't let volatility bully you into panic selling or FOMO buying. Let the market show its hand. And if you want to be part of a community that actually respects process, where we talk about what forces participants to do, what matters this week, and what invalidates the setup, stick around, because the next few sessions are exactly where markets reveal whether a move is real or just loud. One last thing before you go. The biggest danger with gold is in T being wrong on direction. It's getting shaken out by the violence of the path. Price can whip around hard even when the thesis is correct. That's the game. But if you treat the move as math instead of mood, you stop being surprised by the manipulation of your emotions. You start seeing it as flow, and flow is readable. Because if this one level breaks, the math changes, and the market can't unsee it.